Okay, once again, welcome to all of our unit holders, our general partners and trustees on the call today. This is our SG Real Estate Opportunities Trust fall update, unit holder update. We wanted to, again, thank everyone for coming on this call and remembering that we do record this so that anybody who's not able to be on the call today that cannot join us will be able to watch it on the portal or the link that's provided. That's a YouTube. It's a hidden link, so you have to get it from the email address, similar to the invitations to this. You have to get them from the emails that generally come from Mary Thibodeau. So watch for that afterwards. There'll be a PDF version of this as well. There will be some edits between this presentation and the PDF version, just to caution if you're watching the recording and looking at the PDF version and see something different. It's because we are still doing some edits on some of the screens, like the table of contents. Table of contents will be update it when we do the PDF version. So if you were to print it or make it part of your library of information, then that table of contents will be updated when you get the PDF version. So I think that's enough time now for everybody to get on the call. As per most of our calls, I am going to walk through the cursory update on everything that I can touch base on. There's a lot of duplication of information from each quarterly update that I'll try to minimize the amount of time on. The real goal and objective is to make sure that you get the basic updates, you get the information, and if you've got a question that you want to ask, you're going to save it to the end, and we'll open up the last half of the meeting for the Q&A. So put your questions right into the chat screen. Somebody from the team is going to watch that chat screen, and they'll pull that question. The most appropriate person to answer it will likely prompt me when we get to the Q&A and say, hey, Doug, we got this question here from somebody. And if you did want us to review something that you think is more specific to your situation, then please email us. Email that information in and request the time, and either somebody from this team or one of our dealing representatives or planners or Mary or Lavelle or somebody else in the in-house team here will get that information back to you. So again, we encourage you to ask questions. We absolutely want that, but put them into that chat screen and save them to the end. So we thank you for that. Every quarterly, I do an executive remark just for myself, just to kind of a state of the union where we're at. And really, there's two things that I've noted in here as far as the overall. One is obviously we went into the unpredictability of a pandemic and came out of the unpredictability of the pandemic into the unpredictability of a prolonged war between Russia and the Ukraine. And these things obviously are affecting all of us day to day, and they have for the last 3 years. It doesn't matter if it's pandemic related or just simply trying to fill up your car with gas when prices are going from $2 to $1.39 to $1.79 in the course of a 60-kilometer drive that I did on the weekend. That's a true story. The price variation was ridiculous. So it makes for a lot of uncertainty, but it's also the fundamental problem that we have right now with our construction and costing for our build projects, specifically in Ingersoll. And it's not helping us at all. We're now in a position where we're not able to report profits on that project. We'll get to that in the financials, but it's not something that should be a surprise to people to hear that construction costs have gone through the roof. And I mean that literally. Everything from the concrete up has gone up in value, up in price. And not to mention supply chain problems that most of us are familiar with. If your Amazon package that you thought you were going to get or that car you ordered isn't coming on time, it's because it's probably held up someplace. But that's also making it very difficult for the trades and for all of the other related supply chain problems that happen when you're doing any kind of project that has raw materials and labor involved. On the good note, though, the Bruce Power facility, that multi-billion-dollar project to retrofit is continuing to go forward. That is a lot of our general underlining thesis was based around the amount of jobs being created outside the GTA. So there were two factors in our business thesis that we set forward, and this will be going back about 5-6 years ago, that there was a lot of people who were just getting over congested in the Toronto area, in the GTA, and they were looking elsewhere to go. They were looking for lifestyle, looking for jobs, they were looking for more affordable real estate. They were just looking for some place to get out away from the Toronto market. That's not stopping. And the biggest evidence we have to that, if you follow our local news, I know we tend to follow all of the world news all the time, but if you follow in Canadian news, you'll have heard about immigration plans that the government's currently opening up for allowing students who are Visa students that are here on student visas, they're allowed now to expand the number of hours outside of the campus that they can work in the industry. That allows for more bodies to be in the workforce. And also in the medical professional field, there was announcements allowing for qualified nurses from countries that have qualified programs that match our Canadian programs to allow, I think the number's up to about 15, it might have been 75,000. Don't quote me on that, of course, but it was a large number of nurses that they were attracting. That's on top of the backlog of immigration that exists right now, as well as the additional immigration that's projected to be needed. It's a necessary part of the Canadian economic sustainability plan, no matter how you paraphrase that. That was my own words there. But immigration is the foundation of how, first of all, Canada was created, and then secondly, how we grow our economy. Unless you want to look internally in your own household and ask your spouse or your family to, multiply and have a dozen children per household, we just can't keep up to the number of jobs and the growth that we are seeing in this country. And that's really the underlying message, is that we're in a period of time where we're moving forward very quickly, which means inflation is becoming a rampant problem, which means the only way to tamper inflation and get those interest rates down is we need to flood the market with more people that can do the jobs and bring some of those numbers down. Anyway, I'm not going to get in economics on that. I just wanted to highlight that and just say that we do keep a tab on it. We do look for outside resources to kind of give us some guidance on what we think is going on. And we do recognize that we stuck to a very specific business plan with a specific team. On the screen now is our general partners bios. You've seen these lots of times, but we've stuck to that general plan because of what we saw as a migration problem that was happening, a migration pattern that was happening in Ontario. And that continues. The folks on the call right now are trustees, are of course the operating trustees, myself and Randy Von Henking, and then our independent trustees, Scott Lockenbauer, Derek Nunn, and Christopher Wickens, all on the call with us today. Our partners, no big changes here. We have all the same people on the right-hand column, all the same names are working on our files. On the left-hand column, there is a change for brand names. Our lawyers from Miller Thompson and Guelph found out abruptly that their Miller Thompson Guelph office was closing, which certainly scared us for a second, didn't understand what was going on. But it was just a corporate decision to close the office. So Robert Graham and Michael Hanley, who were our lawyers and leading different aspects of the different various parts of our real estate transactions and trust transactions, are still local and they're still working on the file. One is now with SV Law, that's Robert Graham, and the other one has moved on to Mackenzie Lake, and that's Michael Hanley. So they're both still intact and giving us advice that we're equally confident in what they've given us. Miller Thompson, I will say, just for the sake of clarity, we did choose Miller Thompson as well because of relationships, but also they had a good private capital arm in Toronto, and that's when we were creating the structure and we're creating the documentation, which we don't need as we exit the projects. So we don't have now I've got some muting going on. I just got to double check something here.
We're good.
We're all good. Okay. The projects again, there's our general underlying thesis of anything that we would present. Now, we're not looking to build out any of the other properties at this moment. We'll talk about that in our project updates. However, for the homes in Ingersoll, there was a mandate that they are smart, healthy, and sustainable. And we've stuck to that, of course, to the best that we can, given the climate that we're in. Again, I apologize for the brevity on some of the screens, but we're going to skip through because I want to be able to give you enough time for you to have your questions come in. This is just, again, our transition screen here. We want to get into the project updates. So we're going to do the quick project updates, and then we're going to do the financials, and then we'll get to that Q&A. So just bear with me. The market data. Now this screen we've added. We didn't have this before. I was doing just some quick comparisons of what was going on in the market. Just as an individual, if I was a unit holder and I'm watching the news reels and I'm, questioning what's going on, and as the one of the trustees and the operators, I'm also looking at what our, cash flow returns and what our projections look like. But in the last 5 years, we've seen the TSX, of course, going up and down like a bit of a yo-yo here and dropping off in 2020 with the pandemic. And just the last 6 months or so, we've seen again, tapering down. Same with our housing prices. tapering down. Again, I realize it doesn't really seem, oops, I just hit the wrong button there. Pardon me, folks. I'm gonna go back one here. Excuse me. I realize that, highlighting ups and downs is nothing new. There's nothing, we're not trying to do any smoke and mirrors here. We're not trying to compare the TSX market to our returns. I just want to put some perspective on this one point that I'm going to show you in the end here. So the market's going back down and it'll correct. I mean, it as the line does show, it goes down, it comes back. Housing prices are going relatively down, but here's the projection numbers at the screen here. So there's an overwhelming consensus with the data that says the projection for housing prices will just stay flat. And I don't know if this is to be true. The blue line shows the trend of what they believe it to be. I can't interpret this data. I might actually invite Brett later on to comment on it. But what I took away from this, from looking at it as a market comparison, is it's something that we've said for quite a while internally in our GP meetings, is that we don't believe that prices in Hamilton or Southampton are going to go down because they're on the water, they attract lifestyle, they have jobs, they have everything around it. We also didn't believe that they're going to continue to go skyrocketing up like they did. So plateauing where they have and holding this point that we are right now is the overwhelming consensus, that there's so much pent up demand for housing that prices can't really go down too much. Certain markets, absolutely. So I would be fearful if I was in a market where there's no jobs or the major companies pulling out or whatever it is, or there's no lifestyle, there's no water, there's no high-speed internet. Those markets are not going to be attractive to people who are migrating out of Toronto or the GTA. So I threw that up there as a talking point. We can certainly add questions if we have or not, and I'll leave it at that. The other set of data that we bring in has to do with the specific markets that we're in. And again, Hamilton being a market where you can see this red line, it's the price, the median price of the homes. So they've jutted up over $1 million, and then they've kind of come back down. They're heading back for $1 million in the short period of time, over roughly 1 year. What that really looks like, and I'll leave this to Brett later to put more detail, but it's fairly a small sampling with Hamilton, and our property is on the water. So what it tells us is, even though prices took a little bit of a drop when all the interest rates were being pushed higher and higher, and we all know the story. We watch interest rates, all of us watch our interest rates go higher and higher. But again, there's not enough houses being built in Hamilton, so the prices are sneaking back up. We'll look closer at that in our project updates. Ingersoll, we definitely saw prices spike way up. We sold our houses back here in these first set of spikes, probably just a little bit in this area here in 2021. And then of course we're stabilizing here. It's kind of redundant because housing prices doesn't affect us right now. The biggest thing with Ingersoll, and we'll highlight in the update again, is the cost of materials, labor, and everything else is just literally going, as I said earlier, going through the roof. In Southampton, we don't have the data. We don't have as much data, I should say. And Brett has talked about this to the GP several times, that you don't have as many houses in Southampton. So you get these spikes when there's no houses available, and then you get this drop when there's a few houses in the market and there's a scare with interest rates, and then you start to see it going back up. The key part in all of these graphs is we're starting to see that line come back up. And the same thing here for all of the market. I guess we don't have Goderich anymore, that's why. So all of the markets got the same trend line. That's just really reflective of everything was booming, everything spiked, and then we had the interest rate hikes drop back down, and now we're seeing them sneak back up. So that's a good sign. I don't know, honestly, and again, we'll leave it for discussion afterwards. If anybody can tell us if that's going to be sustainable, but I do believe going back to the projected median price that we're going to see this kind of level line. There's just going to be enough inventory to come in to take enough supply to take the demand, and we'll see things continue to go. And we're going to be faced with another interest rate hike, so there definitely will be seeing that come as well. This is our progress chart. Nothing's changed on this chart. We did have some discussions last quarter about our red lines, which were really lines where we placed in there to show when we could maybe market a house to the public. That's really contingent on the ability for us to have approved properties. In the case of Goderich, as everybody will recall, and we'll talk about in our distribution section, when Goderich was approved, we put it in the market, we sold it. And now we've got the Ingersoll got approved, we started building houses, and all the houses are sold. With Hamilton and Southampton, which you'll see, they're both up for sale. They're both at a point now where they're approved. That's good news for Hamilton, by the way. They're both approved to go forward with the proposed zoning and site plans. Hamilton still has a site plan to be approved, but we've got our zoning, and we've got the zoning for 10 units instead of 4 now, which is really the big hurdle. We'll get back to that. Again, these things can be all looked at on the PDF version, or rewatch the video and you can zone in, but we have not made any fundamental changes or material changes to our timelines. Now, going right into the projects here again, just for sake of our archives, Godrich is sold, and we'll talk about the distribution funds for income distribution and capital distributions that we've sent out notices for and follow through on for Godrich. Ingersoll is not the best story now. We've got good progress, and again, we're being transparent. We've got all the houses under construction, various states. You'll see that there's 6 houses now complete, and 6 houses that'll be have or will have changed ownership over the next short period. I think 5 have changed, and maybe 1 more is on the way. And then this is where we were, I believe, in last quarter. So we were at, there were still 4 houses to start. All of the houses are started at this point now. So all of the houses are being built. Everything's sold out. And these are 16 single family homes. You can see a picture. That's a very recent picture there of the units being built. And very easy to see if you're driving in Ingersoll. Please do not go into the construction subdivision, but you can certainly see it from the road as you drive by. You can look in, you can see all the construction happening. The unfortunate side is, we'll cover the financials, is that our costs are way higher than what we can manage as far as anything we can control. And we're certainly trying to minimize the impact it's having, but it is putting us into a loss position at this time. We'll cover that in the financials. As I mentioned earlier, Hamilton is now zoned, and that's an update we missed there. We'll change that. The zoning application has been approved. It's not pending anymore. It has been approved. The waiting period is over. We've got the public had the chance to object to it. No objections. We did a healthy discussion this morning about the current market prices on Beach Boulevard. There's a fairly large home for sale for 1.7, but it's not on the water. It doesn't have that water access. Whereas the current house market with these townhouses and with the we have another mute there. Sorry, folks, I was going to mute somebody else there. We had another townhouse that was up for sale in that $2 million range. We don't just get the numbers from MLS. John and his team are constantly scouring through Hamilton and contacts and real estate agents, and also the waiting list. Brett's got a waiting list now of people who are interested in buying those units, and that's the prices they're told, $2 million plus to get one of these 10 units. And there's, I don't know if Brett can verify, but there's over a dozen people on the waiting list, as far as I know, that are showing interest. We just take waiting list stuff. There's no deposits, anything like that. Our intention here, as with Southampton, is to sell it to a builder and be able to hand it over to them, get the maximum dollar price we can for it, and provide them some confidence that there's people who want to live there. That's what we generate these waiting lists for. So I'm going to show you a quick video of what what Hamilton will look like. I'm just going to queue up here. You can see all of our partners here and our logos. It'll just show the drone footage with some 3D rendering and a little bit of the skyline and a little bit of the lifestyle. So looking back at these Burlington Skyway. That gives a pretty good view there. What you'll notice too is we have the widest area between that trail and the properties. That trail goes pretty close to other houses on Beach Boulevard, which to me is making ours even more attractive, a little bit more space between the backyards and there. So I'll move on to Southampton. Again, Southampton is for sale. It's fully approved. It's ready to service. We've already done the initial servicing RFPs and got everything out. That's fully in process. I'd get Randy maybe later. He can give an update on where exactly we're at with the servicing. But I'm going to take this opportunity to show another just short video without all of the extra lifestyle and footers and trailers in them. This is just going to show you the 3D renderings that we have working in Southampton right now. So again, you can see where those buildings will position. the end product. Take note of how close that lake is right back. That's Lake Huron back there. That's about a kilometer, just over a kilometer for somebody to get down to the beach, maybe a kilometer 0.2. These videos, both the lifestyle ones, all of these ones get uploaded. We use the shorter versions without the corporate logos and stuff, where Brett can take them and use them for our real estate listings. Certainly, if you, as somebody who's a unit holder and has a vested interest in seeing us maximize our profits, if you've got somebody out there looking to, as a builder or whatever it might be, and you want to pass that along, please do it. You'll have the links are usually published straight to our portal that you can go back to, or you can just look at one of Mary's emails. She generally has those links on there. They do change once in a while as far as the video, when we add in the 3D or we add in maybe lifestyle. So just keep an eye on those emails. And if you ever can't find them, just give us an email either to myself or sorry, pardon me. Please don't email myself. Mary always takes those emails, and because I'll just end up pushing it to Mary anyway. Yeah, so here we go in the financials. So this will be, again, an update in the same style we've done when we do audited financials. So in this case, it's the interim financials for September 30th, 2022. That's our internal team here, as well as in consultation with our BDO accountants, one's out of Toronto and one's out of Guelph, who give us their input on things as far as timings. The big thing right now is that we are doing those distributions for, as a result of Godrich's final payments that came in. The financials aren't completely settled yet, but we were able to send those distributions, which I'll cover, out to our unit holders. But the mechanics are still a lot to be done between now and the end of the year. There's accounting and certain regulatory things that have to be done in order for us to close that limited partnership that was created to fund and build out the Godrich property. So I'll get to that more detail, but I want to set that up as you, as a unit holder, when you're looking at these financials and you're trying to interpret them. It's not always easy. You've got a set of financials for this trust up here, then you got all these other projects down here that have their own financials. And as I've noted in previous presentations, you know, transparency obviously is very important, but also understanding the structure and the mechanics. Money flows through from the unit holder to your end custodian some kind of times, like for RSP money, like an Olympia Trust. It'll flow through to the trust, and then it flows straight through to the LP. The LP then does its activity and flows that money back to the trust, and the trust back to the unit holder. So there's always a bit of a delay in that quarter. It can't be done instantaneously at the same time. And I'm going to apologize now. We did a distribution in midway through the quarter, and it turned out to actually create more questions than it did maybe necessarily. I think going forward, we're going to stick to our quarterly distributions. But for those who were wondering, you know, all of a sudden why there's a distribution partway through, you certainly got your statements and your transactions. And I know internally we handle a bunch of questions, but for the most part, it's pretty easy. Flow through. Whatever activity happens in one quarter can be reflected by the end of the quarter. If it's too close, like the sale of a house or the sale of a property that happens in, say, the last 3 or 4 weeks of a quarter, it's not enough turnaround time for us to get the financials completed by the end of the quarter. It'll get pushed into the next quarter. So that's just a little explanation for people when you're wondering, why is there delay? Why is it so complicated? Well, it's a lot of moving parts when you get into the tax, accounting, and legal. So this is the balance sheet for September 30th of the trust. You'll see that there's some retained earnings from accrued from property value increase, which puts the number still at $10 million, $10.2 million of outstanding asset for the trust. What I want to focus on really is on this side over here. It's the unit holder capital. This is the money that came into the trust and then was sent over to each of the LPs systematically for the amount of capital required for each of the projects, and approved by our trustees so that they, you know, we were only able to purchase the properties that qualified in accordance to our offering memorandum. That number would have been, if you look at our previous financials, about $11.5 million, 11,499 something 5. So we've returned capital back to you as unit holders. We talked about this last meeting, and you've seen, of course, communications coming to you. So the amount of exposure for your capital is lowered, which is reflected 100% by the trust, which has flown through to the various LPs. I'll show a little schedule at the end of this that shows where the outstanding capital of each of the LPs is at, where it's at. And hopefully that's what you focus in on. The other numbers are adjustment numbers that are there, like the profit for the year is part of the distribution of income, which you're seeing right now. And the retained earnings is value from property values increasing that we had to capture midway through our capital raise. So again, I don't want to get into too much detail because there's a lot of financials. Please reflect on them if you need to go back and look at them. If there's a question today, just try your best to articulate the question in the chat and we'll try and cover it today. One of the things that we like to update is that we did use some internal financing. So any excess cash that we had sitting on one project, we were able to use that cash first before we went to a third party to borrow other funds. And right now, this is the current outstanding internal loans that go between from one LP to another LP. So you can see that Hamilton has put money into the construction of Ingersoll, as well as Southampton putting money into the construction of Ingersoll. We're trying to get as much of the borrowed money as possible from our construction loan and maximize that. But as we've spoken to COVID and all of the supply chains and construction costs going up and interest rates, made it more efficient to us to stick with this. If we can get more construction finance in a reasonable rate, we'll certainly take some of these internal loans out and send that money back to our unit holders and lowering the exposure of the money at risk for the trust and for our unit holders. So that's our summary there. Again, these ones are going to be a little bit heavy on the screen. I'm just going to focus in on a couple things on each. This is Southampton. You'll see right now here, cash at the end of the period. Not a lot of cash left, and that's not a problem because there's not a lot of activity left in Southampton. We're into what will be now a construction loan for doing our servicing, and then that money comes in, that goes out for a construction loan. But as far as a piece of property right now, that property is fully developed with the exception of servicing, of course, but it is site plan approved, it's zoned, it's ready to go. We could sell that tomorrow if somebody came and gave us the price that we want. Servicing it doesn't prevent us from selling it. And quite frankly, servicing it doesn't give us a huge bump in value. It may give us a little bit of an accretive value increase and make it more attractive because it's easier for somebody to build when the property is serviced. But you really just pay dollar for dollar. You pay $3 million to service it, and you just add that to the price you want if it was unserviced. I'll leave that to the guys, our development team, to talk more of later and maybe correct some of the things I said. Here again, as I prepared you for, right now, Ingersoll is tracking a loss. We're hoping that we'll be able to minimize our losses on the property. This is a really 100% due to increase in construction costs. There's some efficiencies, that we can look at and try to improve, but the costs for framing and everything, it doesn't matter what it is. If you've done any renovations in your home or tried to even buy any products and get groceries, everybody's seen those. So every time you see a price go up and you say, wow, this has doubled in price, that's exactly what's happened in the construction world as well. So we're tracking a loss there. We're looking to minimize obviously the loss, but at this point we're just trying to be as efficient as we can with every part of the process as possible to protect any further losses. From number 4, Hamilton, there's a bit of cash reserve in Hamilton. There's not much left to do in Hamilton. It is up on the market for sale, as I mentioned in the preview there. I don't believe we have a whole lot in Hamilton that has to be done. There's probably some still like engineering for our site plan and things like that we'll have to do. But again, just a bit of a cash position there to make sure our project goes forward. A little bit of delay there, sorry about that. And that's what I thought was going to happen. We go back one. There we go. Double click to it. All right, so Goderich. Goderich is in. It's sold. It's not gone yet. We've done a distribution to our Class A unit holders, and I'll do a little summary on that. And we have on cash at the end of the period showing $596,000 sitting there. There's still a bunch of accounting and adjustments to do, but all of the money is in now, and now it's just a matter of winding up the LP. As I said, there are some legal and accounting and tax issues that have to be resolved before we can wind it up. The goal is to wind it up before December 31st, completely done. Everything is accounted for. And then we don't have things like an audit cost or accounting fees or legal fees for 2023. We don't want the LP to go into the next year. It's actually quite ideal that the property finished all up in the summer, so we have time with our accounting team to get that done before the end of the year. If our property was to be, finished in December, we automatically have a full year of audits and financials and stuff that we would have to do, and it just increases our costs. The distribution that we did send out, and I'll get to that summary in a bit, the distribution is accounted for our Class A unit holders, which is the trust. So just for clarity again, without a diagram or anything, just remember that you as a unit holder is a Class A unit holder of the trust, and the trust is a Class A unit holder of the underlying project. So all of the funds at this point that we believe are attributed back to the Class A unit holders have been accounted for. And that is emphasizing again this flow through wording that you'll hear me say. It just simply means now we're going the other direction. When money came in from the sale of the property, it went into the LP settling in everything that they can settle, and then it goes back into the trust, and then the trust back over to our unit holders again, which is what you see from the distribution letters that you get and the summary statements that you receive from us. A couple of footnotes here. There's 3 things on the screen that I'll focus on. These are really were 3 slides before I just put them into one. The book value, as you look at book value, if you're trying to calculate your own book value, it's what you put out for an investment. So call it $10,000. And we've given you back 16.5% of your money. So now you have a $8,450 of outstanding book value. And the market value, which caused some confusion about it, I guess 6 or 8 months ago, a year ago, is really the last price it traded at. And that market value is only reflective if you have a third party who's willing to buy your units from you, and you're saying, yes, I want this price for them. It's an arbitrary value based on the last unit price sold. And the reason I emphasize this is we still get the question, not very often, 1 or 2 times, we'll get the question about, I want to see my statement, I want my market value that's on there. Well, the market value is only if you sell it to somebody else. And with private capital investments in real estate, there is no secondary market as we put on the notes. So you could come to us with somebody who says they want to buy your units, and the trustees can approve that, and we could do a swap. I mean, you can set your own price. You can sell them at a loss. You can sell them at a profit. You can sell them at double if someone's willing to pay for that. So I just want to make sure you understand that. And we have removed market value, I believe, some of our transaction statements to avoid any confusion of that. It was on there for more as a courtesy value, so people understood where it transacted last. And then on the unit holder notes to remember, I left out, I should have mentioned there was on the bottom screen there, it was business income. We talked about this before. We were trying to convince, all of the accounting advisory firm individuals that we talked to that, is there any way for us to get, more capital gains, dividends, anything that's more tax advantaged flow through from the trust. And they've basically come back and said it's business income because it's a business of development, which is what we've been told all along. We've always had a bit of hope on a short term, like a Goderich, where we've increased the value and sold it. But again, we increased the value through the business of developing the property, and they have defined that as business income. So everything we do is business income. And the other point on here, number 2, is probably important. I should have highlighted that for this presentation, is that the entitlement for you as a unit holder to sharing profit, sharing those Class A distributions that we send to the trust, even if we buy all of your units except for 1 unit. So if you start with 1,000 units and we give you your capital back and you keep 1 unit, as long as you have 1 unit, you still get the same proportion amount of profit that you're entitled to. It's called pari passu, which is a fancy word for everybody is equal. So we have these external independent trustees and these external legal and accounting firms to ensure that we've never changed that entitlement. We can't just all of a sudden pay 1 unit holder over another unit holder. So when we return capital, it's returned to each unit holder exactly the same proportion, so that you have exactly the same proportion of entitlement to the future profits. So it's an important thing. Again, I'd like to keep in every video so that people remember that, and again, ask a question if we need to later. So here's the summaries for the activities, and we're going to roll into the Q&A. So here's up until the end of, as of Q3, there's the project capital. So the unit holder capital invested into Southampton is 3.6 million, 2 million into Ingersoll, 4.497995 into Hamilton, and 1.4 into Goderich. Working backwards, Goderich is sold, 1.4 has been returned back to the trust and returned back to unit holders. Out of the Ingersoll, I think we've got an error here. Did I get this right? 3 of the 16 properties have had return of capital gone back. And then again, it's highlighted because of the accounting that I explained earlier. Some of these activities happened in September. So on the notes, we have 500,000 has been accounted for. I think there's 6 properties that have been transacted. So there's some money that's not accounted for yet. Sorry, 4 properties. Thank you, Brett. And that's just the highlight. So we're chipping away at paying that capital back as much as freed up capital is available from Ingersoll. As homes are constructed, we're paying back that capital as fast as we can because we want to get that money back into our unit holders. And then Southampton again, Southampton and Hamilton, we have not sold anything there yet. We haven't transacted anything. The goal is to transact the whole property. I think I'll have to leave this. I don't want to get the numbers wrong, but I want to say Southampton's around 9 million is the asking price, and Hamilton's around 10 million asking price. I think that's about right. That's what we're looking for. So that's roughly the value that we would expect somebody to pay. About 9 million for Southampton, about 10 million for Hamilton. I'll leave that for Brett later if we need to clarify that. So this is the last summary page, and it really is just the activities that just happened. So I've tried to make sure I've explained all of the mechanicals and movements and timings and things, but here's the quick summary again. The 3.6 still outstanding, so in Southampton, 2 million to Ingersoll, 4.5 to Hamilton, 1.4 to Goderich. That was our initial capital invested everywhere. 1.90205 has been returned year to date, which is 16.5% of the capital. So again, if you had $10,000 invested, you've got 83.5 outstanding of your money still that is owed to you. So on the other side, the question immediately comes from, well, where did that money come from? Well, the most recent activity, as we've talked about, is the sale of Goderich. So I've got the sale of Goderich on here. And this really is the first time that we're starting to look at what is our rate of return and what's our internal rate of return. What's our rate of return for the project? So how much did the project make and how much did the annualized internal rate of return make? So with Goderich, we chose at a time when we thought was appropriate. We had the offer on Goderich. We measured and said, can we sell this property right now without actually having to really build or do anything onerous? We did have the servicing done, but that was handled entirely by the development team and by the town of Goderich. So that went very, very smoothly. It was a very minimum amount of work, short time frame. So from a Class A unit holder, for yourself as a Class A unit holder, the return on the project was 16.9%. And the annualized return for the time and the duration of how long that project lasted was 12.5%. So that's our annualized return, and that's the return of the project. So it's on the lower side of our spectrum from 5 years ago of looking at what we thought was going on in the market. But it's still, in my opinion, a very good rate of return, and certainly stand behind the decision our team made to sell the property when we sold it. And think it was a good decision at the time, and it provided us double-digit rates of return to our unit holders, which was very good. So we'll certainly come back to questions on that, because I know there's going to be questions. But I caution, all of our final audit statements, all of the reporting and stuff comes out at the end of the year. By the time we get to our January presentation, we should have all the final wrap-ups of the LP. As far as I think anything else in that project, I think I'm actually done. I think I'm circulating now. I just feel like I'll wait for the questions. I'll probably be able to anticipate. I know that as a unit holder myself, I was thinking about it and probably have some questions, and everybody may have some. So I'll leave it there. Oh no, I know. Sorry. Last thing I want to highlight was that the return of capital is 16.5%, and then the return on the project. Those are two different things. One is how much money we've given you back, and one is how much did the was made in the form of profit on the project. So, but your total distribution, if you were looking into your bank account or your cash, you would add those two numbers together. That's what you've gotten back from your investment. So that does bring me to the last screen, which should tell us the dates of our next ones. I referenced January already. January 10th, 2023 will be Tuesday. That'll be our next webinar, live webinar. May 9th is our scheduled AGM. As most of you know from being on these types of calls, sometimes the audited documents are not always ready, but We're hoping this year we push it out a little bit later. We've had it at the end of April and I think in mid-April, but that'll be our AGM with our audited financials. And then October 10th, a year from now, just getting that on the calendar. So again, I recommend everybody to stick those in their calendars, and then you watch for emails from Mary on any updates or from our internal system. And then, of course, our Q&A. So at this point, I've asked our team to keep watching the chat screen. I can just do my best to go back to a specific screen and kind of bring that up as people talk to that. And I invite Brett, Randy, if you just want to, start the conversation off with one of the updates on one of the projects. Maybe I'm just giving cursory updates here. You guys can give more detailed updates. Certainly just let me know. Do we have any chat questions? Oh, not sounding like we got many questions. So why don't we, Randy, why don't we go back to Southampton and you can. Yeah,
a little more specific update to Southampton. We were speaking about tendering, servicing, and finalizing our plan of, or not our plan of subdivision, sorry, our final subdivision agreement. We've passed over on the final subdivision agreement for now, just waiting on some surveying to be done. So we have signed a pre-servicing agreement, which allows us to tender and get going on the work to service the property. We've got the tender back and done, and we've awarded the contract to a contractor. All of the contract documents are being drawn up right now by the engineers to sign. And as soon as we get their bonding back, we will begin servicing the property. And we've got some questions coming in on the chat now.
Okay, we've got a question on estimated date. I can see them. Sorry, my screens are full here. I'm just trying to get these up so I can see them. Oh, I see, Brett, you answered the question there. All right, so estimated date when we'll start to see returns of the investment. So again, that's for everybody who's been in there since day one, you've invested X. So I'll use the example of $10,000. You've returned back capital of 16.5%, and most recently, the project returned 12.5%, which is the in the timeline that you've probably invested. By my best estimate, it really only represents a portion of all the projects for that 12.5% of income. So it's whatever income you receive in your bank account divided by the amount of outstanding capital, your book value that you have still invested. I'm guessing it's probably around 1.5–2%. As of right now. But keep in mind that that's reflected on the smallest property, the smallest investment proportionate. So when Southampton or Ingersoll is sold, or sorry, when Southampton or Hamilton is sold, that would be a much, much larger side of the future, profits. So you get that disproportion or that portion. So I'm just trying to read. There's a few questions that are jumping in and I can't quite see them.
I think I can answer Shannon's question about the distribution on October 6th. It was 12.5% of the Goderich specific portion of the investment, which is approximately 11% of your total investment. So it's not 12.5% of all of the money you had invested total in the trust. It was 12.5% of what was allocated to Goderich. So again, a small portion of your total investment.
Yeah, that's a good point, Randy. That's what I'm trying to, I'm just seeing that, are we on track to get 20% ROI? 20% is ambitious given the market that we just went through. We absolutely forecast. Actually, let me start that over. We don't forecast on it. We don't purchase a property that does not give us a 50% gross margin. Now, what that means is if we can't project the sale of a property for 50% more than we paid for over 1 year, then we would certainly not purchase it. So in 2 years, we have to be able to double it. So in the case of Goderich, we made a decision at about a year and a bit into it to sell it at 2.4, which was about a 37%, 38% gross margin on it. And then after you settle all of the costs and financing and whatnot, it did a 16.5%, return to our Class A unit holders. So right now, given what we've gone through with COVID and the Ukraine war and supply chains and all of the interest rate hikes that we're facing, I'm going to just state that I think as a trustee and as a GP partner, I'm very happy with anything that's in double digits. Is there? If we had a perfect market, we would be way over 20% ROI. If we had a stable market and we didn't have the activities that drove up our costs with Ingersoll, I think we would still be in the high teens. But what we have now is a fairly volatile market, but good properties in good places. There was a question there about future builds. Yeah, contracts. Yeah, Brett, you want to talk about how we deal with the sales? And we did straddle some of our sales in Ingersoll, but to the best of the timing that we could do at the time.
My AirPods decided to conk out right at the most opportune time, so my apologies. We haven't put anything into any new contracts because just as material costs were increasing, so were sale prices. So we were able to sell at market value and certainly make money then. The stuff that we sold in March of 2020 and April of 2020 in Ingersoll, as an example, though, was that, you know, we sold at what would give us a decent rate of return to our investors. And then as they were starting to be built, that's when we saw material costs escalating as quick as it did. We did what we could. We held back from selling some of the final units to ensure that we could gauge what the actual cost of materials would be for our few different lots. But it also led to the general partners and the trustees determining of whether or not we were going to build out Goderich, build out Hamilton, build out Southampton. And based on the lack of predictability, what we decided to do was look at potentially selling those off as either individual lots or as a package deal, as Doug alluded to. So for example, Southampton right now is listed at 9.2 for the entirety. We've got Hamilton, where it's actually it's a little bit less than 10 million, but we can revise the price now that we've had more work done on the zoning and site plan application. So there's a couple things that would escalate the price on that to sell. So we're constantly monitoring what's going on, and that's the benefit of having multiple exit strategies, as we've talked about from day one, where, you know, if we get to a point where it's site plan approved and we feel that we can make a reasonable return to our investors and de-risk the fund, then we do so. And that Goderich is a perfect example of that.
I got a couple competing answers here, so I'm going to clarify that. Thank you, Brett. I just see that the question about the how much of the LP amount does the Ingersoll project represent? So it's the trust that holds interest in each LP, and Ingersoll is one of the LPs. So Randy put in at 17.4 and Robel put in at 12.2.
I did my math on $2 million of the total 11.5 raised.
Okay, that's what I thought you did. So the original, it's 17.4 of the original investment, and Robel, you're 12.2.
So 1.4 that was invested.
That was Goderich. So Goderich is 12.2.
All right, so he's going to delete. Robel's going to delete his answer, but I was going to cover Randy's. So going forward, it's 17.4 of the original investment of what was invested, and now there's less capital at risk, so it is lowering the, well, it's proportionally a little bit more than 17.4 of what's left and remaining. So I'm not seeing more questions come up. We should probably anticipate if anything else we should talk about. I think the one question too about that brings in the 17.4% of it. We do have a modeling tool that we're using right now, just to reassure everyone that we're not certainly not trying to avoid anything. We're tackling as much of the construction costs in Ingersoll to minimize any additional losses or the losses what we're projecting now. But the key part is we stick in a modeling tool all of the weighted average of our projects, and we try and project out, and everything that we're pointing towards now is holding the line on getting those top values for Hamilton. Again, waterfront, looking at Toronto skyline, and Southampton, a market that has 20,000 jobs being created throughout the Bruce Power area, not just at Bruce Power, of course, but through that whole area. And if we can get those maximum values we believe that we're sitting at right now, we will still, even with a loss in Ingersoll, we're still going to drive the 12 to 13% rate of return on the trust in the end, provided, again, we don't extend too far in time and we find buyers for those two properties. That obviously it's not taking in consideration all the stuff we can't control. If we see further economic recession from interest rate hikes, or magically inventory is built someplace else and people just decide not to move, or the jobs in Southampton are not materializing. I'm not trying to paint a bad picture. I just want to be realistic that we're taking that into account. So we feel very strongly that our Hamilton and our Southampton properties, which made up roughly 65% of all of the capital, those are definitely our waterfront, water adjacent in the case of Southampton, but those are our lifestyle jobs, perfect little properties that we still have, and we still have the ability to hold out and get our top dollar for. So we're still driving for those double-digit plus returns, which again, we're quite proud of given the market we're in, and certainly, oh, go ahead, Randy.
I just wanted to throw one more thing in there about the Ingersoll project is we do have, if you'll see on MLS, a few of the properties relisted. We have buyers bound to close on them when they're completed. However, they have allowed us the opportunity to resell them. And if we're able to sell them at an increase, which is beneficial to both us and them, then we can increase our sale prices, which will help our bottom line on that project overall. If we don't happen to resell them, everything stays as is, and we do have a buyer in place for them, but it's an opportunity for both them and us to make a little bit extra, allowing us to buy them out of their contract if we can sell it for more. Yeah,
that's a good point, Randy, and we didn't highlight that. That kind of falls in the category of we are working hard to be as efficient and minimize whatever you can. Those steps don't just those steps extend far beyond trying to negotiate better costs for windows, doors, and lumber and everything else. It goes right into can we find other ways to maximize, and that's so for people who have seen these similar houses on MLS, that is exactly what we're doing there, as Randy's explained. So anything else, John? Do you have anything from Hamilton? I got you pretty quiet there. I don't know if there's anything.
No, not really, except that I'm just expanding what you talked about before. We are deemed complete with the rezoning, and we submitted site plan, I believe, last week, and the demo permits have gone through, they've been approved. So we should be demoing to the buildings, I believe, in the next 2 to 3 weeks. So we'll have some update pictures coming to you. Yeah. Other than that, everything's been submitted. It would take between 30 and 45 days before we hear back from the city, if there's any feedback on our site plan. But other than that, we believe by beginning next year, we should be fully site plan approved.
Okay, excellent. All right, unless there's another point, Brett, Randy, thank you. Thank you, John. Thank you, the trustees.